It's also the last trading day of the Biden presidency. So how should you be positioned here with Trump 2.0? Joining us now is Neuberger Berman Private Wealth Managing Director, Holly Newman Kroft. Welcome back. It's good to have you.
Good to have you. Happy New Year.
Happy New Year. So just on this week, I mean, lots of data, some good, some bad. The move lower in yields certainly seemed to help stocks. How do you interpret it?
I interpret it actually as expected and somewhat of a relief. Uncertainty brings about volatility, and we are certainly in uncertain times. As you said, today is the last trading day of the Biden administration. Markets will open up Tuesday with a new president. We're going to have to see how his policies are going to impact the economy and how they're going to impact the market. If you step back a couple of months and you think about the market had such euphoria after the election, it was really on a tear. We started to see a broadening out in the equity markets, which we had been looking for. And all of that euphoria was kind of stripped out of the markets at the Fed meeting on December 18th, where they presented a really hawkish stance, sort of reluctantly cut rates, and signaled that they're going to pause and wait to see how these new policies are going to impact the market. So around that uncertainty, the market went back to the Magnificent Seven because that's what's worked for it the last 2 years. And we're going to wait and see how these Trump policies impact both the economy and the market.
Is it your expectation that we'll see the broadening out still happen because of some of the pro-growth policies of Trump?
Absolutely. We are expecting a broadening out and hoping for a broadening out. When you think that 7 stocks have been responsible for 50 or 60% of the market returns both of the last 2 years, there are 493 other stocks that need to catch up. And you see that in earnings expectations. You know, the Mag 7, the expectations of earnings are to come down from the mid-20s to the mid-teens, and for the rest of the market from flat up to double digits. So we're certainly expecting a broadening out. Two of the new policies Trump is expected to implement, deregulation and lower taxes, are both good for the market and the economy. The other two, tariffs and immigration, could be inflationary. So we're going to have to see how all 4 of those play out and impact the market.
It feels like during that period you point out where you had that post-election euphoria trade, people trying to implement kind of the standard playbook from 2016, 2017. There was this conventional wisdom forming by the election, sell the inauguration. It felt like we pre-sold it because you obviously had 6 weeks when you had a 5% pullback in the S&P. The majority of stock did much worse than that. And maybe it reset expectations, too. I was talking about the sentiment indicators saying people have maybe just gotten a little more neutral and not really sure how it's going to go. If you have modest expectations for what the overall stock market could do and you're looking at corporate bonds at 6%, I mean, how does that change your thinking about how to approach investing in this point?
Yeah, our expectations for the market are actually above long-term average returns, which are around 8%. But if you take a market that has strong growth potential, which we expect for this year, that has inflation coming down, which we expect for this year, and also anchored in a strong consumer, which we've had since post-COVID, historically, the return should be around 10%. So if you think we're expecting a high single-digit, low double-digit return for the market, all with being able to get corporate bond returns of 6%, taxable equivalent yield in munis of over 6.25%, that's good for the investor. We have been spoiled the last 2 years with the market cumulatively being up 60%, but a low double-digit return is a healthy return for the market, and the volatility that we're seeing gives investors the opportunity to reposition their portfolios that arguably are more risk positioned, just given the trends in the market the last couple of years.